Hi, so thanks so much for inviting me to this conference. I'm very excited to kick it off. So I'm going to talk about consumer collateral here, and specifically consumers using their household as collateral for lending. This is joint work with my former colleague Ben Collier and then Ben Keyes. So what does collateral do? Why do we care about collateral? So one, collateral is very important. It's very large. So there's if you add it all together, there's about $12 trillion of debt in household debt in the U.S. that's collateralized. The vast majority of that is collateralized by the household, the physical home. And so we care about collateral. Why does collateral exist? For two reasons. It's to align incentives. Well, also for banks to be able to repossess something, but I'm going to ignore all of that. So in order for collateral to align incentives, you need two things to happen. One, the consumer has to actually value the collateral. They have to care if they lose it. This, for households, for homes, this could be both that they have equity in the home, and it could also be that they have some non-financial attachment, like you're living in a school district, they live near their parents, something like that. And then two, in order for the incentives to even matter, consumers have to have some discretion in repayment. So there has to be some moral hazard in lending. And there's been a lot of this research recently of maybe consumers don't have quite as much discretion as we thought they did. So this is a massive market. It has very interesting economic questions. Why isn't there a lot more research on this? Because identifying these effects is really hard. So collateral is almost always part of an equilibrium outcome that's jointly determined with interest rates, lending terms, etc. And then even the data is hard because most of these markets are very segmented. So they're either everything is collateralized or nothing is collateralized. It's almost never a market for consumer lending where some are collateralized, some aren't. So what do we do? So we have a very unique setting, and I'll talk a lot more about this in a couple slides, where consumers have the option to avoid collateral based on borrowing a lower amount than a certain threshold. And so what we're going to be able to show is that using these weird government rules that don't actually make sense but are great for research, we're going to be able to show how much consumers are willing to give up in super subsidized lending. And so by super subsidized, I mean below treasury rates, very subsidized lending. They're willing to give up about 40% of what they would have borrowed with the super subsidized rates in order to avoid collateral. If you do a back of the envelope calculation, just making some interest rate assumptions, it's about $25,000 in net present value that the median borrower is giving up. This could be much higher for credit-constrained borrowers. We do some structural model at the end, but it's a big number. And in the second question, do collateral requirements actually have something to do with you defaulting a loan? We're going to use the fact that this threshold, that I'll talk more about in a second, moves over time. So we're going to be able to use that to identify, as an instrument to identify the effect of collateral on default rates. We're going to find a strong effect. So collateral is going to reduce default rates in this market by about 35%. It's the equivalent to about a 100-point increase in credit scores. And then third, we're going to be able to estimate how much non-financial value consumers place in their household. Because we get to observe their equity, we get to observe their behavior in avoiding collateral. And so from that, we can actually back out the part of the value of the home that we don't see. Find a median value of about $11,000. So the way I like to think about this number is that it's if someone came to me and said, I'll pay you the house's market price plus X, what's the X you would accept to sell your house? We find that X median is about $11,000, so it's very skewed. There's a big mass at zero, and there's some people who it's hundreds of thousands of dollars. All right, so now I'm going to talk about some institutional details. So the program we're going to look at here is a U.S. federal disaster loan program. So it's run by the Small Business Administration and lends to small businesses and households. It provides very low interest rate loans. Usually the vast majority of loans are 30-year fixed rates. Low interest loans to households who are affected by a natural disaster. So this covers uninsured damages. It's a wide variety, but think floods, hurricanes, storm, wind damage, snow, wildfires, things like that. And then they only cover the uninsured portion. So for some of that, it could be the loss was so bad your insurance maxed out. Some of it could be you have a $10,000 deductible, or you could just be uninsured. And so the weird government rules, so the approval decisions for this have nothing to do based on the availability of collateral. Okay, that doesn't go into the equation at all. It's determined algorithmically. But If you have collateral available, and that means you own the home, even if you have a primary mortgage, and you borrow an amount larger than a certain amount, this is moved over time, you have to post collateral, okay? You always have the option of borrowing exactly that number, so currently borrowing, borrowing exactly $25,000 and not posting collateral, and getting whatever else of the money you needed to fix your home, get it from elsewhere, okay? One important thing that causes a lot of questions. So in practice, the collateral doesn't actually do anything because the SBA never collects, okay? We've spoken with the SBA. They specifically said they don't. They start borrowing way less. And the reason for that is that they're all bunching, or many of them are bunching, okay? So how do we estimate this? So this is literally just the diff and diff you see at the very beginning. You have group fixed effects, you have time fixed, or threshold, there's only two groups. And then we just interact it with the loss bin. So this is sort of, you can think of it like the time variable, it's the thing that's running along the x-axis. And so these beta j's, they're going to be our treatment effects. Okay, this is how much the difference in lending is between these two groups. And we're allowed to control for things here. So importantly, we control for things like credit score. We see people's full credit reports, the value of their home prior to the disaster, how much equity they have, things like that. And importantly, too, for us is that controlling for things isn't really going to make too much of a difference. Okay, it doesn't change the estimate that much, and that gives us confidence that there's not some other thing that we're missing that would change it, would change the estimates. All right, so when we run this equation, this is what it looks like. So to the left, again, this is the difference in loan amounts based on people having that loss, and when there's no collateral requirements, there's no difference. Okay, this is our sort of the pre-trend event study. Immediately after, the difference starts growing. It does level out, and if I extended this graph, it would actually come back up in like a sort of U shape. And the reason for that is as you get further and further and further away from the collateral threshold, the probability of bunching becomes much smaller, and it eventually just goes away. Very few people are giving up, $90,000 in this market to only borrow 10. Okay? So from this reduction, because bunching is binary, we can actually back out the probability of people who bunch in each loss bin. The loss bin where about half of people are bunching and half aren't, that's the median of the collateral version, median level. It happens to be about, for this one, about 18,000 is where this backs out to the median. And so on average, the median borrower would like to borrow 18,000. They're willing to give up $8,000 of super subsidized lending to avoid having to post collateral. Okay? This doesn't change at all if we show covariance, if we include covariance. Okay. So we also, in addition to this difference in bunching, for some borrowers, for many borrowers, we actually just observe their ideal loan amount. So when you fill out this, when you apply to this program, you fill out a form. The form does say the collateral requirements on it, although it's on the second page and not in the biggest of type. So it turns out that, like many of your students as well, people don't really read instructions. And so you have to list your requested loan amount, but basically no one seems to know about the collateral requirements until they actually talk to a loan officer and are forced to sort of fill out this paperwork. And so we can just look at their original requested amount. We observe this. And so for the few people that do bunch, we use a matching procedure. It's in like Appendix G or something in the paper. And then we'll be able to see this difference between their final loan amount and the amount that they originally requested. And we do a couple tests to show that this original request seems pretty accurate. For people below the threshold, the average difference is about $115 or something like that. It's very small. All right, so this is the distribution. So this is showing that about a third of people bunch in their final loan amount, but only about a third of those people bunched in their original request. So we have these 2/3 of bunchers where we just directly see, and then this the bump there in the green line where we're using the matching procedure. Okay, this one also, not a difficult equation. All we're doing here is just a series of how far away are you from the threshold, and then that's it. Then adding in controls, okay? And so what each one of these are going to give us is the people who are, say, 5% away, what probability of them bunch. And then the CDF is literally just 1 minus these betas, okay? So when we run this is what we get. And it looks good. CDF slope up, so this should slope down, and it does. At the lowest bin, so people will give up about 0 to 5% to avoid collateral, only about 80% of people bunch, okay? So these are people who don't really seem that bothered by posting collateral. Once you get a little further away, so the very other tail, the 75 corner, some people really care about collateral. Some people are willing to give up huge amounts of subsidized lending. And just like the difference in bunching, even though this is using a completely different identification source, it's using, in some parts, different data, the median here, so where that probability of bunching at 50 hits, is about 39%, okay? So all of these methods we're going to find into, yes. So every method we find, no matter how we subset the data, if we include covariates or not, we get extremely consistent, around 40 to 50% as the median, okay? And so taking this number, taking the average ideal loan amount from the people's original request, we back out a net present value of about $25,000, okay? So here's also just the CDFs of these two methods, just to kind of show you exactly how similar they are. The traditional bunching one looks kind of similar up until it has some weird assumptions about where the thing ends. And so we like the difference in bunching as our primary method because it feels the most identified, it has the prettiest pictures. The downside of it, though, is we can only observe it up to 25,000. So we have to kind of project beyond that. So that's what the screen line is. Okay. So yeah, so if you add up, so people don't like posting collateral, they're willing to give up a lot of subsidized lending to avoid it. If you add up all of those amounts over the data we have since 2005, people have given up about $1 billion to avoid having to post collateral. I have a separate paper that estimates demand for this program, so price elasticities. This would be equivalent to, this reduction is equivalent to doubling the interest rates. So going from about 2.5% to like 5 be a similar sort of demand response. Okay? All right, so now we're going to switch here. So we find people, that first part of do people like their homes and don't want to have it, they're afraid to post as collateral? Yes, very, very clear. Okay? So now we're going to shift gears to the second part of does this collateral do anything? Do people have some discretion in their repayments? So there's 3 channels. So if we just run an OLS, and I'll just show you this OLS, regressing default rates on do post collateral, there's 3 separate ways that relationship's going to happen. So the first, the one we actually want to estimate, is this moral hazard. People who have collateral, they suffer more if they default on the loans, therefore they default at a lower rate. Okay? That's the one we care about, that's the one we're going to try and find. The second one, though, is that, well, people choose their loan amounts. Loan amounts also heavily influence whether or not you default because the payments are higher or lower. And so whether or not you collateralize, in our case, it's actually just mechanically connected, right? Because you determine your collateral based on how much you borrow, okay? So in our setting, the really large loans that have low repayment rates are going to be non-collateralized. The really smaller loans that do have higher repayment rates are not going to be collateralized, okay? And then also we have the obvious sort of selection issues as people are choosing whether or not to collateralize their loans. People choose things for real reasons. So how are we going to disentangle these? So we're going to use that same sort of difference in bunching. We're going to use it as an IV. Okay? And so this is, you can think of this as our first stage, it's the graphical version of our first stage. Is that we're going to be comparing households that have, in the same sort of loss amounts but they had them in different years, okay? So someone had a loss of 24,000, say. In 2007, they have about 40% chance of bunching, or posting collateral. In 2013, they have a 35% chance. And in 2014, no chance at all, because they're below the threshold, okay? And so we're going to sort of look at this sort of like a kind of a within estimator, like a two-way fixed effects within, and compare people in the same loss amounts, but across different years. How do we do this? Again, two-way fixed effects diff and diff. And the first stage is almost exactly the same as the probability of bunching, except it's 1 minus the probability of bunching, because now you're posting collateral. We're going to use this first stage as an IV into the second stage, just in like a 2SLS version. Take predictive values from the first stage, stick them in the second stage. Glenn's not here, so he can't yell at me for using probability models. And yeah, so then the second stage, this theta is going to be our causal effect. The more default, they think they're going to default way more, their default rates are way more likely. We don't think that's really the case, but that's also a different SEER conference, the behavioral one. So I'm not going to talk about that here. They might have accumulated equity. In practice, so legally, if your home is foreclosed on, you're entitled to whatever extra equity there is. The bank doesn't just get to keep it. In practice, that's never an issue. Almost always, home foreclosures are sold at such low rates that all equity is just wiped out. And so mostly because the banks don't really care about preserving your equity because they're going to get their share. And also, so in practice too, like some people who have really negative equity, some people who are way underwater, it will take decades to get out of how underwater they are on their mortgage, still bunch, right? That's weird. And so what we're thinking, this sort of extra part, is that people may have this attachment to their home. So they really like the school district, they don't want to move, moving's a hassle. I had to move cross country last year, it was awful. And so since we observe their accumulated equity, and we observe default rates, we observe whether or not they bunch, we can actually back out. We can say, how much would they have to value their home in order for this bunching behavior to make sense? Okay? So we're going to set up a very mini structural model where the key trade-off we're trying to think about is that the consumer has two options. They can take the collateralized lending contract that has a low interest rates, and therefore low repayment rates, or they can take a non-collateralized loan that has higher interest rates, higher repayments, but in the case you default, there's no extra penalty. Okay? And so that's what this is going to look like. So these gammas are going to be default rates that we just estimated exactly the way I showed you in this last section using the IV. The P here for repayment rates, these are just amortized repayment rates at different interest rates based on what these household ideal loan amounts would be. We're going to estimate the ideal loan amounts the same way we did in the first section. And then this fee here is going to be at the end, this is the extra cost of defaulting if you're collateralized. So this is the cost of losing your home. It's going to be split between the equity portion we observe and this attachment portion that we don't. Okay? And so we're going to have three main assumptions for this. The first one is that we're going to have some CARA utility. That's largely because there's a wealth term in here and we don't actually observe wealth. Okay? We observe some proxies for it. But when we use CARA, the wealth drops out. That's really nice. The second one is we're going to use quadratic utility, and that's because we're going to take a Taylor approximation of the utility function. We do that to not have to worry about like calibrating prudence and things like that. And then the final one is we're just going to put a functional form on what this attachment looks like, or the distribution of it. We're going to say it's log normal, conditional on covariance. Okay? So if you make those three assumptions and do a bit of algebra, everything actually reduces to a probit. So a latent variable model with a normal standard error. We actually observe the hurdle, and so we can back out the distribution for this attachment. Okay? So we have to assume quite a few things in here. So the payments here we discount going forward, so we have to have something to discount them by. We have to assume what these non-collateral costs of lending are. And we're just going to kind of pull these from literature or from various FRED data sets. So the risk-free savings rate, so how we're discounting into the future, is going to be just an average one-year treasury over our time span, which is right about 1%. For the non-collateralized interest rate, so this sort of outside option from the program, so we think of this as like sort of personal loans. Importantly, you shouldn't think of this as like your outside option is a home equity loan, like a HELOC or something like that, because those are also collateralized. So there wouldn't be any real difference there. So your outside option, we think of it as these personal loans. We found data on personal loan interest rates during our time frame from FRED, and so we just take those rates and figure out how different they are from mortgage rates. Okay? And on average, they're about 4% higher than the 30-year fixed rate. Risk aversion level, we're using CARA, so the number looks a lot different than you would think of with a CRA. We pulled this from Cohen and INEV as sort of one of their main results. All of these numbers I'm going to vary and show you how they impact. And then the non-collateral cost of default, we just put $5,000. That's sort of close to this Lieberman paper. It was estimating how much people will give up in income to avoid bad credit. That number's not going to really matter too much, as I'll show you in the next slide, so we're not too concerned about that. All right, so what this is showing is I'm showing you using the top row is our base assumption. So all those numbers I just showed you, we plug those in the model and solve it. We find a median level of attachment of about $11,000. Okay? So how does varying those coefficients, how does that impact our estimates? So if we, first row here, we double risk aversion. Okay? So people, the default state, so the small probability that you default on the loan becomes a lot worse if you're more risk averse, which means people would care about that equity loss more, which means there's less room for attachment. And so it lowers our estimate. So if we double risk aversion, our median attachment drops to about 8,000. If there's no risk aversion at all, just use linear utility, then it bumps up to about 14,000. Obviously, the outside option matters as well. If we assume that there's a worse outside option, or a better outside option, so lower interest rate, then this median attachment drops to just under 6,000. If we assume the outside option is a bit worse, then it bumps up quite a bit to almost 16,000. And so this is sort of where this line is where we're saying that these credit-constrained consumers, the ones that are giving up subsidized credit, their outside option is going to be much worse. So here, if we were saying, okay, your outside option is a payday loan, this interest rate becomes more the mortgage rate plus 300, something stupid. And so the amount that they would have to dislike collateral to take something like that is enormous. The discounting rate, so the savings rate, what we're discounting by, that also has a big impact. If you're getting a lower interest rate, but that interest, the value of it is spread across a long period of time. So if you discount that those future payments less, then it's not collateral is not a big an issue. And if we assume there's no discounting at all, then we get a slightly higher. Okay? And then the sort of non-collateral default costs don't really seem to have an effect. It's in both states, it's our utility, it's not surprising. Okay, so I'm definitely going to end quite a bit early. It's not forcing. So in conclusion, we have a really unique set. It has a lot of weird government rules that let us identify some of these things that you can't really identify in markets. We find that borrowers really hate posting collateral. They are willing to give up a lot of money to not have to do it. Ex ante, about 40% of their ideal loan amounts that they will give up to not have to post collateral. This result is extremely robust, 3 different methods, largely different data set, or largely different people. We're very confident in that. After the fact, so once you've decided to post collateral or not, this fear of losing your home does lower default rates. And this is kind of in contrast to some of this very recent literature on sort of casting doubt on the double trigger. Magnitude's large, and it suggests a substantial amount of consumer control, and helps say that maybe collateral is actually working really well to align these incentives. And so, yeah, collateral really matters, and this is even in times of acute need. So people, it's not just that the interest rates are low, these are people who've had a very, very large negative shock to their wealth. They need this money now. And so there's also, we're showing with this attachment that there's an extra lever, an extra sort of trigger, if you want, of why consumers don't default on mortgages that are just super underwater. If we take the estimated average attachment and the average equity, we find that people value their homes by about 15% more than the actual equity they've accumulated. Okay? This might help explain some mortgage behavior like high default costs, things like that. All right, so that is all I have. I did not time this quite as well as expected, but extra time for discussion. Thank you. Literally. Thank you.
So, cost of consumer collateral evidence from bunching. It's Cam, Ben Collier, and Ben Keys. And I just wanted to start by talking about this federal loan program, which you mentioned has a lot of quirks. Okay, there's many sorts of exogenous variations, and I'll start by giving you a bit of credit for the research agenda that you're pursuing, exploiting all of these exogenous variations, basically. So you get a loan to repair uninsured damages to your home, and the first quirk is that there's an exogenous variation at a 40% debt-to-income ratio. So if you have a lower debt-to-income ratio, you're much more likely to get the loan than not. The second quirk, which you talked a bit about, is that they have these very highly subsidized interest rates that change quarterly. So there's variation between what the market offers and what they can offer in the program. And the third important quirk is the collateral posting that happens at $10,000, $14,000, or $25,000 depending on the use. So you can think about interest rate elasticity in the demand for credit. You can think of the causal effect of providing credit and the effect on the household balance sheet, and the impact of collateral requirement on the consumer behavior. So just a bit of publicity for Cam. He has an amazing paper that sketches out a nice demand curve in response to these interest rate changes. So they have many different interest change over a large domain. I believe it's forthcoming in Econometrica, so important paper, big plug, really nice, really interesting paper. And they can show you that if there's a 1 percentage point increase in the interest rate, people reduce their take-up by about 26%. So awesome paper. Some of this methodology is used in this current paper also. The second thing, which I kind of have a preview of this paper because we've seen it at the Risk Theory Society last year, is exploiting this second quirk where if you're under a ratio of 40% debt to income, you're more likely to receive the loans, and if not, so you can use a different methodology, and then you can look at the effect on the household balance sheet. So people who get these loans are less likely to bankrupt or become delinquent. And this brings it up to this paper here. So the question here is about the collateral requirement and how does it impact consumer behavior. So Cam really presented this well. They exploit the loan amount threshold that vary over time depending on years. It's like $10,000, $14,000, $25,000, and people self-select into these bunching thresholds depending on the year. So their identification is going to be comparing bunching behavior across these threshold regimes, and then the assumption is that given a loss amount that you have, this threshold is random, just depending on the year in which you got the loss. And then we can infer the value of collateral, the impact it has on the payment, and finally the value of home attachment. And the punchline is that median borrowers will forego about 40 to 50% of this loan amount to avoid collateral. It reduces the default rate quite a bit, and then you find about $11,000 in loan and home value attachment. So how do you do it? First thing is you see that there's a lot of bunching on these threshold amounts. Very few bunching on the original request, probably because people don't understand the implication of the collateral requirement, but also because, as you note in the paper, they have the right to change the loan amount at virtually any point in the process, my understanding. So at any point, you could learn about this collateral requirement, you could change your mind, even maybe after getting the first payment, if I understand correctly. So you get your first 25 uncollateralized amount, and then maybe even there, you could change the loan. But in the end, there's high bunching at these thresholds, and what that provides is a counterfactual on what would have you done if you weren't in this regime. So comparing what people do in the $25,000 collateral requirement regime to the $10,000 regime, you can look for a given loss at a counterfactual if there was no requirement. Because this is just binary, as you said, you can back out basically the percentage of people who are bunching, and then the percentage of people, the percentage of your loan that you would forgo. Once you have this, you know basically how much people are willing to give up in their loan amount, and you can use the exact same thing in an IV to instrument for the probability of posting collateral. Again, because in each of these loss bins, you have a different probability of posting collateral depending on the regime in which you are. You instrument for collateral and you see a big reduction in the default hazard. And then the last thing you can do is back out, basically you know the equity on the home, you know with putting a bit of structure around the problem, you can back out the default penalty, and then you just distribute it as losing all of your equity on the home and some residual, which is your home attachment. Okay, so honestly, I think this paper is very well written, very well done. For me, the first thing that was a little bit weird is trying to think about your first lien, so your mortgage, and the second lien. And I would have thought that if collateral aversion is really important for people, someone who doesn't yet have a mortgage would be more reluctant to post collateral, because it's like the extensive margin of now I get really in trouble, and now if something happens, now there's a real risk that I lose my home. And that's something you don't see in the data. Yeah. So here we're showing the loan to value of these guys, and we're looking at the probability of bunching. And of course, you self-select in bunching, and there's advantageous selection even in bunching, but there's really not an effect that people who don't have a mortgage really dislike posting collateral for the first time. So I see the effect in, there's a small downward sloping probability in bunching the more you have, the larger the loan to value. But I would have imagined that if the story was very compelling, at zero you'd see a big effect, and then it would be discontinuous, and then the intensive margin would be smaller. I think the good news is, as you said, you've estimated this home attachment for everyone in the sample, you have a value for everyone, so you have a lot of heterogeneity in this amount. And it feels like the paper goes through all of these nice models, and then it leads up to a structural estimation, you get the value for everyone, and then it concludes with presenting the median. I feel like if there's one thing where you could work, where I'd like to see more work, would be on this distribution. You say you have a lot of covariates, you probably know where they live, the zip code, the partial zip code, you know their credit score, the income. So can we back out a bit who has a high value of home attachment? And I think that would be interesting for me. So when I was reading the paper, basically the question is who values collateral and why? And I think here you have a very nice measure, very precise, a nice distribution, seems reasonable. So I think you could do a bit more up here. The other thing that you could think about is the refinancing option. So you could think that, well, people don't want to have a second lien because then it's going to be harder to refinance the first mortgage. But depending on your bank, I guess most banks would say if you have enough home equity in total, we can always absorb the second lien. So I don't think that would change your model that too much. I think if you wanted to investigate this, you would just say once you collateralize with the second lien, maybe your outside option is a bit more expensive. And then I know in other papers you have the credit bureau, the credit report. So I was wondering, if these guys really don't want, exactly as you said in your presentation, so if these guys don't want to collateralize, they shouldn't be using their HELOC. So there's kind of a big gap in the amount you have to post on your house. And if you could show that these guys are not using the HELOC, that would be, I think, really, really neat. That would confirm that they don't want to post collateral. Because if they're just going outside and using their HELOC, then I think it reverts to still using collateral, whether it's on the first or on the second. So that's what I have. Really great paper, great research agenda. It's really nice to see this data being used this way. And best of luck with the paper.
Awesome, thank you so much. Yeah, we haven't thought about using the post-credit report data just because it was two separate projects and we never thought that we would allow that. And the only sort of response I would have to that, oh great, suggestions all around. It's a little hard for the attachment to then, because that attachment is estimated conditional on those collateral, all those covariates. So just rerunning that regression will sort of give you as just zeros. And sort of we kind of trying to balance what do we want to have estimate with covariates to make it conditional, and then what do we want to say, okay, how do these covariates influence this actual number? So trying to find a balance there. We definitely went on the balance of just all include everything. But thank you so much. Obviously we see the slides. Yeah.
So on the structural model again, Philip's point was actually very similar to mine, that you sort of end up on this, like you go through all this trouble of writing a model, estimating the distribution of home attachment. But then, I mean, you build a model then normally to do counterfactuals or maybe look at the program design. Like could you take this one step further and think, okay, so now that we know that there's collateral aversion and home attachment, now could you redesign the program or change some of the parameters of the program to maximize whatever? Now I don't know enough detail about what is the objective function of the program itself, what they're trying to maximize, but could you think of like using those estimates to then do a little tuning there?
Yes, we definitely could. So the other paper estimates welfare for the program. So we estimate demand curves. So we have like willingness to pay. And then, so we could look at how the collateral, like the collateral threshold or point or whatever, has two things. One, it makes people borrow less. People like the program, so that's bad. But it also makes people default, having collateral requirements makes people default more.
Yeah, exactly.
Or default less, which is good because it costs the program less. So we do have like
there
pretty
has to be
detailed
an optimal default and
an optimal like structure of how to set the collateral requirements, or if maybe there's none, maybe it's everyone's collateralized. That's really interesting. That would be pretty. Yeah.
So just a clarification, you mentioned these, maybe you mentioned it, but how are these loan losses amounts computed? I mean, are they
They're on-site.
officers or are they can they?
It's on-site loss adjusters, so we're very confident in the actual loss.
So they cannot be manipulated in any
No.
way. I was thinking maybe people tend to over-report these losses in order to get a higher loan.
Yeah, not to any meaningful sense, because the program has its own adjusters. They go in and check.
So they go on site and check.
Yeah, on site. And you also can't, if you have insurance, they contact your insurance companies directly as well, so you can't like say, oh, this was actually uninsured, I want to borrow money. And then for losses above 50,000, or loans above 50,000, I didn't show, there's actually a little bit of bunching right at 50,000. Above that, you also have to like have receipts for everything. Yeah.
So this is a very annoying question, not in the sense that I'm questioning your exercise, but I want to hear your thoughts on, is this the value of posting collateral in disaster when I'm under disaster?
Yeah.
And my demand function is now a demand of the sad emoji, right? Or does it speak more to, we learned that there is a value of posting collateral in any moment, but the number only speaks for disaster, or do you believe that the number speaks no matter what's my emoji?
I definitely think the point estimate speaks for disasters. So in thinking about, this is one, your house, the collateral itself is literally damaged. That's why you're borrowing money, is to fix it. So your sort of value of that collateral should, if anything, be lower than it would be in normal times. The other sort of is there's these papers on like salience in disasters where you just suffered a disaster, now you're either more aware that they can happen, maybe you overestimate that for the future. So in the sense of like maybe you're worried that like another hurricane will hit, that'll kill your business and now you're going bankrupt and now the collateral matters. That would be one where our point estimate would be too high. But if you think about all of, like there's a lot of like sort of external validity style questions here. Most of them tend to point to our estimate being a little low. And that's sort of what we think people definitely care. Given the setting, our point estimate's not perfect, but it's probably a lower bound, would be my guess.
I don't know if you're aware, I really like your paper in the sense that it's a great compliment to Tony Cookson and colleagues' paper about the wildfires in Colorado. They show a bunch of evidence on GoFundMe campaigns and how, like, in the limit, that was the only way to actually get funds to go and rebuild the houses. And so that kind of explains, maybe they had the option to go borrow, but they didn't want to post the house as collateral, and the GoFundMe was even an alternative that they preferred to actually borrow.
And so I definitely think, and looking at the credit data is a great idea, the future credit data is a great idea. Is the sort of biggest weakness here is we don't actually see what people's outside option is. Like for the structural model, we say, well, they're just taking a loan from somewhere else because that was the one that was really easy to model. But if instead they're like taking money out of their 401k that was invested in the stock market, well, there's penalties, there's taxes, there's lost equity stuff. In practice, that's actually probably a little more likely than a personal loan, but you can't really solve that as well. So yeah, I definitely think that's probably the biggest weakness, especially for the structural part, is we don't know what people do. Yeah.
So kind of along the same vein, I'm trying to think about the validity of these sort of things like designing, when you get a mortgage, what's the maximum LTV? Which is kind of similar problem, not exactly the same. So in this setting, it's the weird thing for me is, you know, I'm giving out a loan on an asset that is the damaged asset, right? That's the thing that's being collateralized. So is there a sense in which some people don't even demand these loans because they might think that their house is a total loss, for example, or they want to do major renovations? Like, how are these things valued? Because typically you don't collateralize with the thing that's actually being borrowed, right?
We borrowed to fix.
Yes, exactly.
So I think you could say that like sort of the fixed home is the collateral, like so in the sense of, because you are using the money to fix it. But there's definitely, there's some margin of people who, like they do view the home as a total loss. Typically, they will still at least try and sell the home. That's often very difficult if there's flooding is the reason.
So do you see, for example, is this a loan that's topping up other loans, or do you only observe whether or not they're getting this loan?
Yeah, so we don't observe the other things they're getting. We do know that if they're getting these loans, they're not getting FEMA grants. Those two programs are kept separate. And actually people who get rejected from this program are diverted to the grant program, and vice versa. And so, yeah, we don't see what else they're doing. We do, not a fair number of people take the maximum loan of $240, but it's not, I mean, some do, that's not that many, so it's not that they're running out of stuff in the program. My suspicion is most people are taking this. So if we look at loss amounts and loan amounts, it's pretty 45-degree up until the collateral threshold, and then once you get well past it, it gets about the 1-to-1 again. Because these loans are just really cheap. They're really cheap. They another benefit of these versus others is you don't actually have to start repaying for a year, which is really nice in a disaster time. So we think these sort of dominate every outside option, but we can't say for sure. Maybe not GoFundMe, but yeah.
Yeah, just a clarification. So to estimate the structural model, I mean, again, maybe I didn't get during your presentation, do you use an SMM, and which are the moments that are most informative about your parameters?
So we don't use moments. So with the the Taylor approximation, the algebra works out really nicely you get a first derivative of the utility function, so the Taylor approximation, the normal utility functions all cancel out. The first derivatives and second derivatives, if you just divide everything by the first derivative, that's where the risk aversion comes in. And so if we calibrate that, we actually just get a linear model, linear like hurdle model with a normal standard error, and so it's just a probit. So we just run it as a probit. Yeah.
I was wondering about household selection here, in the sense that natural disasters are not so exogenous to a certain extent because households keep getting natural disasters specific to their locations and things like that. How does that kind of selection affect the likelihood of taking a loan? Because if I live in an area that is likely to be affected by natural disasters time and time again, how do you disentangle the exogenity there?
Yeah, so I guess that would be, so we definitely don't disentangle that, in the sense of I would call our stuff sort of a treatment effect on the treated. That said, being a sort of repeat, at least in our time frame of 2005 to 2018, being a repeat customer is extremely rare. Maybe it's because once people have suffered a disaster, they buy insurance. But we don't think that there's too many, just the kind of people who just stay in a flooded house and it floods every 3 years or something like that. At least not that are applying for this program. So as far as people, though, that disasters are much more likely on, say, coastal areas, things like that. The best we can say is that we control for income and stuff like that, but none of this sort of mental stuff of the kind of person who likes to live in Florida, something like that. That's a good question.
A couple of questions. So, you mentioned these different bunching thresholds that they change over time. Is it possible for people to update that I used to take it early on 10 and now the threshold moves up to 15, now I can take out more?
No. The threshold's based on when your disaster is declared by the president. So every loan term is disaster specific. And so even if you, say, wait and apply 2 months later and the threshold is moved, it doesn't matter at all. It's when your disaster is declared. So there's no benefits to waiting of any kind like that.
And if you think about this value of attachment to the house, I echo Philip's that there's probably more the distribution there that can be, especially since it's a very skewed distribution. Do you think it would affect the willingness to accept if you sell your house, that it translates into values there?
We like to think that, and I think we have that as a how, and that's is sort of a way to think about that. It is a very different decision of and there's a lot of sort of risk aversion involved in thinking, oh, I'm going to lose this house versus, oh, I'm going to sell this house, my choice to do so. I would probably, as far as policy recommendations, I would probably lean more towards the does this make banks offering higher than 1 LTV loans optimal versus really trying to translate it into estimating people's willingness to sell.
More along the financing decision.
I would be much more comfortable with that.
There is this neighboring literature in more behavioral finance that looks at if you bought a house at the peak of the market, that you're much less willing to sell your house because you have sort of this historical price.
Yeah.
And we were thinking of maybe this could capture a little bit of this higher value along a different dimension.
Oh, yeah. So you're saying that I bought a house for $600,000, it's now worth $500 based on the Z estimate or whatever. But I paid $600,000. That's how much. Okay. And so there's literature saying that people are way less willing to sell, as a sunk cost kind of thing.
That's sort of acts as a reference point.
Okay.
That the historical price you paid acts as a reference point, and then the first opening bid that you put the house on the market, conditional selling, is way too high. And as you go along on the market,
So we don't see, so we could get at that somewhat. So we don't see people's original house purchase. We do have very detailed, we actually see their home address, so we know exactly what house it is. But we do see their, if they bought it recently, their like mortgage origination, the mortgage amount that they first said, and then how much it is now and how much it's worth. So we could definitely look for something like that. So people who were in areas where housing went down versus people who were in areas where housing went up. And some bunching behavior, we could definitely look at. Yep.
So I have a question, two questions about this. I think the first one is, these are the people after natural disaster, how accurate are their beliefs going to be about the probability of default? The second one is there is increased uncertainty about the economy going forward, right?
Yeah.
I don't know whether that particular neighborhood is ever going to recover, will I lose my job, and so on and so forth. So in that sense, how much, I'm not sure how which parameters you use to calibrate your model, but your parameters could, is there a way to adjust for the fact that these are the people?
Yeah. So we use the actual default rate. So we run that the IV model estimating with all the controls, whatever, estimating default rates based on collateral. So for every person, we have like a predicted value for that function, so predicted default rate. So we use those predicted values as the individual like probabilities of default. And so the calibration is we use the actual program. So the sense of, oh, there might be neighborhood effects that actually do increase default rates. That part we would be capturing. The difference would be whether or not people's beliefs about their default rates, how those diverge. So that would be really easy to do because we could just add like, say they're 5% more likely to default than they actually are. They believe they're 5% more likely, or they believe they're 5% less likely. And that would just show up as another like 2 rows on that table. It's a good idea. That ties it to a lot more of the salience literature, future expectations. Thank you.
We have more questions? All good? Okay, well,
Awesome.
thanks for a great discussion.